such an asshole.
Hey kids, how you doing? AssholeConsulting.com down here in the Southern Command. I apologize to the client. I'm a day late because I had to do some research and I had to fly down to Vegas again. Had to. So now we're at the Southern Command. Hey Captain, I was wondering if you could give an opinion on peer-to-peer lending as an alternative form of debt-based investment as opposed to other debt-based vehicles. Thanks. Made the payment and like if a response. I've heard that peer-to-peer lending has high return on investment. Equities are known for it. No. We'll differentiate between stocks and bonds and cash flow and capital gains. Very key differences. Even after the broker, lending club, and Prosper takes their commission as well as safety frequency of payment of bonds are known for. It is true that based on the figures I saw, you have higher rates of return for equivalent risk. But again, it depends on what you invest in. It's not like a guarantee because you get to choose what you invest in different peer-to-peer and Prosper and lending clubs. So if you lend subprime, yeah, you get, statistically speaking, a higher rate of return. But that may not be the case. You could have a batch of people not pay you back and you take a bath on a peer-to-peer loan that you made. I have the impression that you have more control over who to invest in as compared to putting money in the market, hoping it goes your way compared to mutual index funds, individual stocks. While the default rates are similar, if not better than most bonds, excluding junk bonds. I'm inclined to agree. I haven't seen statistics, but I may be inclined to agree with that because these guys sound like they're automated underwriters when they do the research and analyze the credit risk of the borrower. These guys are serious. They're not bankers who just make them and then sell the loan and don't hold on to it and take more of a broker position. Trust you me, I worked in banking. Bankers are fucking morons. So these guys are, I think, thankfully the newer generation. Plus their business model does not have any room for buddy. Well, you know, Jim's a good guy. We here do things the Wyoming way. And as long as you're fucking my cousin's sister's brother's daughter and my wife, we'll lend you a loan because that's the Wyoming way. You got yourself a double wide trailer for collateral. Well, hot diggity. Built in 73 and the shingles are falling off. Well, we'll lend you $100,000 for your Dodge double Hemi Dodge diesel truck there now. That doesn't happen. Anyway, getting back to the task. I'm a 22-year-old with some money in equities, but I would also like to have money in debt-based instruments for diversification. I'd like to know if peer-to-peer lives up to what's advertised, given that I am far too young for bonds and most fixed asset investments. Yeah, you're 22, dude. I mean, there's nothing wrong with investing in bonds or fixed incomes, but all right, let's start with the basics. Most people are looking into peer-to-peer lending because they are sick and tired of their 0.1% interest rate they're earning on their CDs or the savings account. And so peer-to-peer lending comes along. You can earn anywhere between, based on the statistics, you can research it yourself, between 4.4, which I'm going to use, I think that's more accurate, to 12%. Now again, the people earning 12% are constantly trading in and out. They're on top of it. They don't let their cash sit. They lend it out if it's paid back early. They take high risks, higher default rates, but higher risk comes higher returns. In theory, statistically speaking, not guaranteed. So that's between 4.5 to 12. My question to you is, do you want a risk-free investment that will provide the exact same rates of return, perhaps even more? And if you say, yeah, I'd like that, well, then welcome to the world of where I'm Dave Ramsey and the cursing, hate-filled, non-Christian version of him, me, and Robert Kiyosaki, although he's more leverage your money and all that, but pay off your debts. And the reason why is that it's risk-free, but the cash flow is much higher. If you have credit card debt, you are paying anywhere between 10 to even 30% interest on that credit card debt. And that's fine. You could go and invest in peer-to-peer lending and say earn 7, but there's still a chance that they'll default and you're not going to get your 7% rate of return. Whereas if you have credit card debt or any other debt, the risk is you. You are all the risk. So since you're not going to screw yourself over, this is a truly risk-free investment. So before we even think about peer-to-peer lending or bonds or interest rates and all that, first ask, what is your highest interest rate debt that you have right now? And if that's more than 4.5%, 5%, even 6%, 7%, 8%, pay that off. That's what I'd recommend. Okay, now let's say you paid off your high interest debts and your medium interest debts, and you got like say I don't know, a car loan that's at 1% or 0% interest. Sometimes you have a no interest car loan. There's your mortgage, maybe you got it at 3.5%. Still, I'd be paying that off. I mean, you're going to be hard pressed to find a risk-free investment for 3.5%. You certainly aren't going to get that in treasuries. But let's say you've paid it all off, or you have whatever interest debts you have, they're very, very low interest, and now you want to invest your money in lending and bonds and all that. I am generally for peer-to-peer lending because of the research I've done and what the client suspects is that they do pay higher rates of return, and I would say for equivalent risk. I would also say that the companies that do peer-to-peer lending, like Lending Club and Prosper, I say their underwriting is much more professional than the Who Dang Diglies of the Wyoming way. So it does not surprise me that they are lower default rates and higher rates of return because they're just better at underwriting and they're not charity cases. No guarantee again, no guarantee. But there's that. So yeah, if you got nothing else, that is where I go. But there's a little bit, I don't want to say a cost, but you got to put some effort into it. You got to sign up. You got to fund it. You got to stay on top of it. Like you just can't, it's like the 401k, my God. Oh my God, I had clients. One client, I invested in a 401k for 25 years. Did you invest it in anything? No, I thought it just, so this poor woman had been putting cash into her 401k for 24 years, but didn't invest it. Didn't direct it anywhere. Which is why you might want to think about buying bachelor pad economics. Just an idea. Same thing with peer-to-peer. You fund it, but now you got to go and choose which loans you want to lend to. Okay? And these guys have done all the underwriting, meaning analysis, credit analysis. They've analyzed the borrowers. And you can kind of select your risk. But yeah, there's going to be a higher interest rate paid, generally speaking, no guarantees, in peer-to-peer lending that where you're going to find buying a bond, investing in a mutual fund of bonds, or any kind of other fixed income type of investment. Now here's the problem though, and this addresses the young man here. He's 22. What does he say? I've heard that peer-to-peer has higher return on investment than equities are known for. Now you're confusing the two. And this is where we got to delineate. Not only talk about the difference between stocks and bonds, meaning equities and fixed income, same thing. We got to talk about the differences in cash flow. Okay, stocks you own, part of the company. Bonds, you are lending the company money. You don't own any of the company. Stocks are also called equities. Bonds are also called fixed income. It's a wonderful world of finance and vocabulary where they come up with multiple terms to make themselves sound smarter than they actually are. Regardless, because you have equity in the corporation, meaning you own stock, you are not paid an interest rate. You are paid a share of the profits that the company decides to pay out. That's called the dividend. That is the only cash flow and the only thing that gives the company value, or that stock value, is the annual profits that are paid out to the shareholders. Because why else would you invest in it? Same thing with a bond. A bond, you lend money to the borrower, and they agree to pay you interest. Right? Since you don't own it, it's called interest, because it's borrowed, it's not owned. It's not a dividend. And you're paid in interest. But again, it is a cash flow, a source of income, interest income, that you're paid, and it's as a percentage of the amount you lend, 2%, 5%, whatever. It doesn't even have to be stocks or bonds. It could be property, rental income. You generate rents, and they have price to rents, and you can do the reverse rents to price. What kind of rate of return am I getting in the form of rental income? Now, hear me and hear me well, oh many followers that I have, and many more, because you should forward this to your friends and your loved ones, your mommies and your fathers. The only thing that matters, and this is not opinion, and I know you're going to hear some fucking Ivy League schmucks who just are like, dude, bro, dude. The only thing that matters, the only thing that give assets their value, be it stocks, bonds, property, corporations, whatever, is the underlying profits, be that interest, dividends, or rental income that they generate. That's the only, because why would you lend somebody $10 million if they're not going to pay you interest? Why are you going to invest in a corporation if they're not going to share their profits? Okay? Why would you invest in rental property if it's not going to pay you rent? So the whole reason you're investing in these investments, these assets, is because they're going to generate more than what you invested over the course of their life in the form of profits. That's how you get a positive cash flow. Except stocks and equities, same thing. Americans and, well, people all over the world treat that a little differently. We invest in stocks. Why? Why do people invest in stocks? Because I hope the price will go up. I'm an educated college graduate. Hey. Well, why did stocks prices go up? Why should they just go up in perpetuity? Why forever? Why do you invest? No one looks at underlying fundamentals. No one looks at cash flow. No one looks at profits or dividends. It's always, I invest in my 401k because the price will go up. Then I sell it for more. Don't you ever wonder why that sounds not right? Magical? I just invest in this and it goes up in stock price forever? Well, that's why we have a bubble now. If you read Bachelor Pad Economics, you can learn about that all later, but that's not the point of our topic of conversation. The point here, as pertaining to the client's question, is, it has a high return on investments equities are known for. No, it does not, because when we quote the rate of return on equities on stocks, we are including the dividends and we are also including capital gains, meaning the price appreciation. And to be quite frank and blunt, the only reason stock prices have more than doubled, I think even tripled, since the pit in 2009, 2010, is because we flooded the economy with money. We have low interest rates. You have baby boomers lowering all this retirement money into the economy. That printed up, we tripled the base monetary base, M1 money supply. We tripled the base. We only doubled the M1. It doesn't matter. Larger point is there are multiple amounts of money floating around. We have low interest rates, so corporations borrow, they buy back their stocks. All that money has now flooded the market, so your profits have remained more or less constant, but prices have gone way up. So now you can expect to get a whopping 1.8 to 2% rate of return. So in the form of dividends, the only thing that matters. So in that regard, yes, Mr. Client Man, you are correct. Peer-to-peer does generate higher rates of returns than the S&P 500 stocks in terms of cash flow. But everybody else is also obsessed about capital gains and price increases, which I say is not a thing. It's not a thing in my world of investing. If you pay me, what are you going to know? Not me sold to somebody else and hopefully play a game of hot potato and tulips. All right? Look it up, tulip, bobo. All right? What are you generating on a quarterly basis in terms of profits for me? If you look at it this way, in other words, a dividend yield of 1.8% basically means you invest $100 and every year you get $1.80. Who dang? Ain't that swell? Anyway, so in that regard, yes, cash flow rate of return, peer-to-peer lending has a tendency to provide higher rates of return than the S&P 500. But when you throw in capital gains and price appreciation, no, it doesn't, because the market has been going gangbusters and is quite literally insane. It has delinked from any kind of underlying fundamental value profits that give it value. A lot of people, well, you see, risk is so much lower. Yeah, fuck you. Debt to GDP of 105%. Sure, slowing economic growth. Right. Risk, it's just all rosy like it was in 2006, right? So yes, they do provide a higher cash flow rate of return than equities, but not the capital gains prospects that those do. Even the broker takes a commission, safety appearance. I have the impression you have more control over who to invest in as compared to putting money in the market and hoping it goes your way. That is correct. You have more control, but people have been statistically proven to be very bad choosers. Now you bring up an interesting point here in your kind of second part of your paragraph. Compared to mutual fund and index funds or individual stocks, while the default rates are similar, if not better than most bonds, excluding junk bonds. It depends. See, what's great about index funds is they typically beat the individual. So if you really want to be lazy about it, you could go ahead and invest in the market through like the Barclays index if you wanted to. You could also try and pick individual stocks. We're not talking stocks, you're talking bonds, okay? Because you're lending now. We're not dealing with equities. And yeah, you could do index funds or a mutual fund, but again, you got to choose the mutual fund, and maybe that won't beat the index. But you do hit it right here. They are providing higher rates of return and lower defaults because it's a different ballgame. They're getting rid of the bankers and they're replacing the bankers with themselves, so it's lower operating costs. And I think they're doing a better job of underwriting, frankly, which will explain it. So the peer-to-peer lending, what I'm bringing up here with a mutual fund or an index fund is those are already diversified. And this brings up one key thing about peer-to-peer lending. You can't just make one loan. You have to spread it across different loans, okay? Not your eggs in one basket sort of deal, right? So I would definitely invest across 5 different loans of varying maturities and yields and risks, depending on your risk tolerance. But you're just not going to get the diversification you do in an index fund or a mutual fund, but they're not providing the rates of return, so screw them. So yes, if you're looking to get fixed income, I go with peer-to-peer lending. Now here's the problem in your particular case. You're 22. There's got to be a lot of other investments you can make when you're that young than lending out money earning 5, 7, 8%. I mean, if you're loaded and you're the next Bill Gates and I just don't know that, okay, fine, and you're looking for a place to park a ton of cash, you just have nothing else to do, fine. But like I said, paying off your debts. But another thing, you're 22, all right, is there some, what's your background? Are you in IT? Are you in computers? Are you in engineering? Are there other certifications that will help boost your salary and income? You guys know I'm very suspicious of higher education. But if you're in the right field and there's like this certification that you can get, or you can go to a programming boot camp or whatever, you get skills, that's where I would invest your money because you're going to get a higher rate of return over the course of your life. And there's the risk you won't ever get paid for it, but that's a lower risk than an English degree. So that's something I'd look at. And then even maybe like looking at a house at 22, I mean, now you got to go and do reconnaissance, man, you got to travel, but if you're at a place that you know it's great and it's wonderful, and you're going to be there for a while, I might be on the hunt for property before I go and invest in peer-to-peer lending. Again, totally heavily contingent on your personal situation, personal, financial, social, and familial situation. But I always recommend young men and women, if you know a place that you like and it's no state income tax, it's not filled with liberals or leftists or communists or parasites, which are all one and the same thing, by the way, I would start. It's always good to have like a place that rests your head that you can rent out to trustworthy people. So that's something I did. And it's just because the peer-to-peer lending is so low. And then even though the stock market is horrendously overvalued, I don't see it stopping. I'm starting to view the stock market. Now, it is overvalued, and I have, again, other private investments. That was another thing. Like, if you got an entrepreneurial idea and it's good, now, I'm going to do drop shipping. I've got an idea for a website, and I'm going to sell lint. Well, called Lints is Us. What do you think? No. But if you got a good entrepreneurial idea, you want to start a welding company or a plumber or whatever, that'd be probably a better investment. Where are they going? Peer-to-peer. But the stock market, if they just keep printing off more and more of this money, it's fungible. It's going to end up in asset prices. And so it's kind of almost like a slow-moving Zimbabwe market or a Venezuelan market. If you look at the Zimbabwean and the Venezuelan stock markets, they've gone through the roof. It's because of hyperinflation. The real value hasn't gone up. But it's almost like, Australia's property market is kind of the same thing. It's like, it is insanely overvalued. I would never buy property in Australia. You're nuts. But for those of you who are in Australia and you do own property, your houses have proven to be a very good hedge against inflation because that's where the money inevitably ends up. It's borrowed, reinvested through corporate buybacks, gets into the financial system, and it will find its way to asset prices, be it housing, stocks, bonds with low yields. So I would not necessarily be against having a little bit of your money thrown into equities. Should that be the S&P 500? No. But this revisits the importance of diversification, right? Some property, some fixed income. In your case, very little. Investing in private investments, your education, your investments, perhaps an entrepreneurial idea. And even though the stock market is overvalued, I would invest just a little bit into an indexed fund as more of a hedge against inflation. And this is on top of your precious metals and some cryptocurrency and all that other stuff. So given your youth, and then we could talk about the S&P 500, but you're so young, you'd be like having a completely different risk profile. I'm sure if you look at Vanguard's target dates, they have you in, and you can use that as a proxy, or you could just do robo-advisors. They'll throw you into high-risk funds, but you're going to be international, Asian markets, European markets, Eastern European, not developed, boring, shitty. We grew at 0.5%. Yay, we're France. But Eastern Europe, Russia, Mexico, second developing world nations, that type of thing, where there's a little bit of hustle and people actually work and men actually still have testosterone. So that's probably your investment profile that you probably see in a target date like Vanguard. So what, 22? What's your retirement? 2050? Yeah, about 2050, 2055 might be your target. Take a look at that. That'll give you an idea of what, if you're going to invest in equities, not only as the potential for capital gains, but as a hedge against inflation, and get in on those growth industries. Yeah, I'm kind of curious what a Vanguard 2055 retirement, even 2060 might look like in your case. So, but yeah, am I for peer-to-peer? Yes. This is one of those things like cryptocurrency finally got off my ass and did it. And definitely I'll go and do it. But like I said, I got other stuff that I'd rather invest in. There's other projects and entrepreneurial ideas that's where my money's going now. Secret ones that nobody knows about. You may be using them now without knowing. It comes right back to the old Clairmeister. So especially people in my audience, I know you guys got the entrepreneurial streak. Don't discount that. You're going to get a higher rate of return. Again, you want to make money, go advertise on Tom Likas. You want to make money, go advertise on Terrence Popp. You want to make money, go advertise on world-class bullshitters. Your rate of return is going to be pretty darn high there. Higher than what you're going to get in the S&P and some paltry savings account. But yeah, if you got nothing else going on, you're older, you just want that 4 to 8%. You want to beat the crappy interest rate you're getting at your bank. Yeah, peer-to-peer lending, assuming that you might lose money, but it's got a pretty darn good track record now. It's been around for like 12, 13 years. And it's something even the old Clairmeister might consider, but that takes time. And that time would take away from hiking. And I want to have fun. I don't really necessarily want money. All right, that's it. You guys got questions, the old captain's got answers at assholeconsulting.com, where you could give me money for advice and wisdom. We got my books over on Amazon.com, where you can give me money for advice and wisdom. You go to the Clary podcast, where you just get the wisdom for free. You don't have to do that. But if you feel guilty, you can do two things. You can donate to my Patreon account, patreon.com/AaronClary, or if you want something in exchange, and I don't know why more people I don't know why Patreon exists, frankly. Just go through my Amazon affiliate program. Go to CaptainCapitalism.blogspot.com, look for the Amazon banner, click on that, do your shopping. I get a 6 to 7% cut, and you don't pay any more. That I was like, and then after a while, I'm just like, screw it. Okay, we'll do Patreon. I'm trying to figure out something. That's what I'm going to do down here in Vegas. Because I'm going to work on the Patreon thing, try and get some fun shit going on. And like, oh yeah, I want to do a pinup calendar of the cute Cappy Capite girls. That as soon as some of them will get back to you. All right. Anyway, all right, we'll see you guys later. Tools.